All right, good afternoon, everybody. Event Trader coming on here, and we are going to do a run through of the Sentiment and Flow show. First time we've run this in a while. Obviously, without Brett, we will be missing a key ingredient for it, but hopefully we can provide you enough data and information to really set us up for the final 2 months of trading and kind of get a sense of where we stand with everything on the sentiment side and positioning side. Unfortunately, the commitment of traders, the CFTC data, unavailable to us for this particular show. So, we should hopefully be getting some of that. We do have some other positioning data from some of the different fund manager surveys that we've seen as of late. So we can get a sense of where money stands right now. But without any further ado, we're going to get into this, hoping to keep it within 45 minutes. Obviously, if there's any questions, feel free to ask in the room. Uh, might, I think we should be able to get a couple of polls out that I'll be running for follow-ups over the next few days. But for now, let's just focus in on some of these slides and where we stand in the broader market. So first things first, let's take a look at Q3 earnings as they've been coming in. Real strong numbers there. 84% of the S&P 500 companies have beaten their Q3 estimates. This compares to 77% last year. So, and we didn't really see as much reining in on the consensus side this time around either. So this is just pure earnings beats, improvement in operations, margins, and it's been an impressive quarter to say the least. The average beat, it's been 17% compared to about 23% last year, while the average miss, that's been about 15% compared to 12% last year. So some bigger misses coming in there. The average beat's not as strong as the prior year, but definitely something that we will be watching here. We're through the crux of it. The majority of companies have reported in the S&P. I think we're about 70% of the way through. So still some key earnings coming this week and into next week. But the bulk of earnings, especially via market cap with those big cap tech names, have hit the data or have hit the wires. Real quick question about the senior loan officer survey. Not sure if it was coming out today. I was under the impression that it was going to be delayed, but one headline that we will be watching here is around the Treasury, the quarterly Treasury funding numbers. So we'll be keeping an eye out on that. That should be out around 3 o'clock. All right. Year over year earnings, they're up 18% on average, median growth around 10% versus 16% and 6% in the prior year Q3. So pretty solid performance there. Strength, it's being led by cyclicals and growth sectors. Actually, I do stand corrected. It looks like the senior loan officer survey has been dropped. So we'll take a look at that after we get through with this. So, okay, we'll take a look at that senior loan officer survey, make sure that that's not going to have any impact on the broader market here. So, just kind of working our way through strength again, led by cyclicals and growth sectors. Uh, Performance varied across industries. And again, we'll talk about that here in a little bit. Overall, though, Q3 results showed broad earnings resilience. Um, Showed broad earnings resilience with fewer misses, but slightly narrow margin of outperformance. So definitely good Q3 earnings season, providing us a list, the performance here, or providing a tailwind to the performance. All right, so let's take a look at some of these market characteristics going on currently. Active managers, they've swung from about just 35% equity exposure in April. This is when the S&P was at about 5,000 to over 100% leverage long with the S&P near 6,900. This is the highest exposure since July of 2024. So you can see, there is the potential for managers chasing performance here, but there is a ton of exposure at the moment, which is one of the reasons why I've been looking for a pullback the last couple of weeks here. U.S. money market funds assets hit a record 7.42 trillion. We're going to get into the liquidity situation here in a little bit. Now, I know that there's a lot of people have talked about this money being set for an avalanche to come off the sidelines if we saw any sort of pullback, but it doesn't quite work that way. I was doing a look at some research back on performances in money market funds around pullbacks, and the money doesn't come out as quickly as you think. I mean, if it's the idea that we're pulling back because, say, the economy is weaker or that, we're in a bubble, people are still more intent on keeping their assets in safer positions. So this MMF asset number gets thrown around a lot, but I wouldn't expect that to be necessarily the cavalry waiting to come to the rescue here. It's just, but there is a lot of money that continues to hit record numbers here on a weekly basis. So up to 7.42 trillion sitting in money market funds. Now the SPY, it's gapped up at the open on 69% of trading days over the past 6 months. All right, that's the highest rate since 1997 and even above the dot-com era. It just kind of shows you some of the strength and momentum that have been going on there. I thought this was an interesting piece. When the S&P is up 15% year to date, entering November, the November-December period has risen 20 of the last 21 times. So momentum tends to build on strength. So we're 10 months down and we got 2 months left and we're seeing a pretty strong performance running up to it. It's going to be real difficult to knock that off the pedestal. So that's a number that you definitely want to keep in mind here. Um, Watching some of the other other items, S&P 500 up over 2.5% this month, but less than 200 stocks in the index are up. It's just, we've been talking a lot about the breadth going on. So that S&P 500 rally, it's really been getting the heavy lifting um, from the large cap tech names. Uh, Again, markets have stayed risk on but concentrated. Participation below early bull levels. We've only got about 55 to 58% of the NYSE Nasdaq stocks advancing in October. Again, goes to that number that we just discussed with the 200 in the 200 names in the S&P 500. Breadth is positive again, but not broad-based. Leaders, growth, momentum, quality names have all been providing a push here. Now, stocks are in an upward trend across all time frames in the short term, medium term, and long term strength. So this going off of the Keller model. So again, momentum behind us. Commodities, the triple uptrend alignment, broad strength there. The 20-day and 50-day moving averages group, only 35 to 40% of the stocks are above that 20-day moving average and 50-day moving average. So we have seen some damage here in the short term. Again, one of the reasons why I've been open to leaning on this market here the last couple of days. Now, we've held up pretty well, all things considered. So, again, that kind of plays into the idea that while leadership's been narrow, it's been strong enough, and we haven't really seen that big pullback to knock off any of the trends. Again, the 20-day and 50-day has seen a cooling on that front. So we'll continue to track that, see if that starts to switch. Now, the 100-day, we got about 50 to 55% of the names trading above the 100-day, and then 55 to 60% above the 200-day. So both of these are in healthy um, healthy long-term structures. The market, while in a consolidation phase, is not reversing when we look at this data. So a few other numbers from October here. Crypto, Bitcoin, that fell 12%. Ethereum, rough month for that. That dropped 18%. So again, seeing some risk appetite cooling on that front. Commodities, you had the CRB itself up 0.6%. Nat gas, the standout here, up 25%, but there is some seasonality involved in that. Now, one of the things people wanted to discuss is the seasonality factor. So as I was going through this, and real quick, we're already seeing a breakdown below that 68.83 level right now in the S&P. So let's keep an eye out on that. That's must-hold territory for the bulls. Um, so we'll be watching this as we go along. The lows, down around that 68 area for the afternoon. It's something that needs to be tracked here. So nat gas up 25%. But as I was talking with the seasonality, I'm going to do another show just with seasonality, and I'm going to do another one too with the AI bubble. We'll touch upon both of them briefly, but when I was trying to wrap everything up, it just really created a monster of a report that probably would take about 3 hours to get through. So I'm just going to kind of break it up into a couple different areas. Precious metals in the month, gold continued its winning ways up 3.6%, silver up 4.3%, and copper up 5.4%. So we saw those inflation hedge flows going in. Oil, that's down 2.4%, and it's been range bound. OPEC did pause over the weekend their production uptick. So we'll see if that has any impact on oil moving forward, but we are moving into a seasonally weak time for crude. The dollar, that was up 2.3%, small rebound there, eliminating some of the commodity upside. Again, flow favors been large cap tech, AI, and quality. Selective inflows into utilities and healthcare as defensive hedges, but they haven't been strong across the board. Outflows have been primarily from energy, financial, and staples the last 2 weeks. And then we have seen small and mid-cap liquidity remain constrained. Investors, meanwhile, maintaining a risk-on bias with mega-cap concentration. The S&P, we talked about that 50-day moving average. The S&P is above that 50-day moving average for 125 sessions. It's the longest streak since 2011 and one of the top four in the past 30 years. So, again, pointing towards that broad-based strength. Now, there was a Hindenburg omen that was triggered. I'm just throwing this out there. I know a lot of folks like to discuss these Hindenburg omens, but one of the things that I did find interesting is that the S&P 500 has declined 83% of the time within 2 months after this pattern. Now, what pattern exactly is that for the Hindenburg omen that I'm talking about? The number of stocks making a 52-week high and the number of stocks making a 52-week low were both over 3%. And that just shows the vast divergence going on in the markets. And in the past, again, past is not indicative of future performance, of course, but 83% of the time, that's the number that'll make us stand up and take watch. And again, this is within 2 months after this pattern is formed. So that starts bringing us in towards the end of the year. Recall last year, we saw some of that selling kick off over the Santa Claus rally and just never got the Santa Claus rally. And that led to a little bit of a shakeup going on into the beginning of the year. We would get the aggressive shakeout coming when we got the Canadian and Mexico tariffs, and then of course we got the DeepSeek piece there that really led to a breakdown. But just kind of keep that in the back of your mind. And then I had that in twice. I do apologize for that. And then again, just kind of reiterating some of the pieces here about the top heavy posture that's going on. So obviously we need broader participation here to help us out. So this chart I thought really kind of set the standard here. This is being borrowed from your Denny research as well as LSEG data stream. And it's the SPY versus the RSP. That's the equal weighted S&P. You can see 22-year low the last time we saw this divergence hit these levels there. The ratio as of October 30th was 1.11 times. You can see this generally runs much higher than that, and it's just showing signs. I mean, if you were looking to trade that, that would be uh, a bit of a head and shoulders pattern that would be going on at the moment. So, do we see this really bifurcate even further and more money piling into that large cap and out of the cap weighted? That remains to be seen over the final 2 months of trade. But this is something that we need to really kind of keep an eye out on moving forward here. This divergence, we want to see that equal out. If it doesn't, and we simply get a top heavy rally into the end of the year based around momentum, then that's going to raise a red flag for us moving forward. But the bottom line with this market characteristics is nothing that's jumping out of the ordinary in terms of what we haven't discussed before. It's the market's just simply too top heavy, needs some greater breadth to really be able to maintain and sustain itself until and if we do not get that, well, then you see a few things shake out here on those mega cap tech, and it's going to have a real outsized hit to the broader economy. So, or to the broader markets and indices, I should say. So, bottom line, not a lot of changes over the last month or two in October from what we'd seen preceding running into this week, into this year-end rally. Again, there's some short-term aspects in the 20 and 50-day moving averages for trends that suggest that we could get continued consolidation or a little bit of a pullback, but nothing that suggests that we're ready to roll over here when we're looking at the longer term trend and the momentum that's in place here. Okay. I wanted to talk about liquidity real quick, and in particular, this M2 money supply, which you can see continues to march higher here as we get deeper into the year. Now at 22.21 trillion dollars here. That's just a ton of liquidity. And again, this kind of builds into the idea of where can markets go at these levels here with this much liquidity. We've talked a lot in the past about trying to push a beach ball down in a bathtub, right? Where there's just so much liquidity, it keeps popping back up, and that's kind of what we have going on in the broader market here with all that M2 money and supply. So, just kind of watching it play out on this front, it just points to the amount of liquidity that we are following here and making it extremely difficult for any selling to take place just because that money's got to flow somewhere. We already know that there's a ton of money in money market funds. And we're seeing lots of money naturally flow into the stock market because they have no other area to go for these returns. So we'll keep an eye out on this M2 money line, but that again just points to the liquidity that's sitting out there in the markets. All right, let's break into the Bank of America Fund Manager Survey and talk about some of the elements from that. Now, this is a little late, a little dated on that front. We got the last survey 2 weeks ago, of course, but wanted to highlight some of the things that we're seeing in that. First, investor mood. That is the most bullish since February. And it's going to be a common theme that we're going to see on the sentiment side of things. We've got equity allocation at 8-month highs. Bond allocation at the lowest levels since October of 2022. So everybody's flowing in to equities and out of bonds, except for Warren Buffett, of course. For those following Berkshire, I think they bought 183 billion in treasuries last quarter, or they now hold 183 billion in treasuries, which was a record high for them. So Buffett is the one person piling in here, but everybody else, as you can see, running into that equity allocation and away from bonds. Now, of course, that could set up for a reversal. Um, so, certainly watching that December decision coming out and see how that plays out. But again, this just points to the potential for positioning to be in the on the bearish side. However, again, that liquidity that backdrops this here, that equity allocation kind of gives it a little bit more support. Again, right for a possible small shakeout, but upward trend still firmly in place. Cash, well, that's down to very low 3.8% in the Bank of America Fund Managers survey. So, that's another sign that some of this positioning could be offsides. But again, liquidity, the liquidity conditions, according to the fund manager survey, are the best since September of 21. So there's no shortage of money out there when we look at the M2 money supply. Um, we see the equity allocation extremely strong on the positioning side, but just keeping an eye out on this. The suggestion is that the amount of liquidity that's still working its way through, this goes back to the COVID days and everything, is supportive of holding up any sort of small pullback due to over positioning. Uh, Recession fears, well, they've faded sharply according to the Bank of America Fund Managers survey, which is interesting given how poorly the small caps have done compared to the large caps. You'd think that that would be a little bit more broader based, but again, sentiment's very high that the market's doing well. So a couple of bad data reports could shake things up on that front there, perhaps cause leading to some um, some pullback. Now, real quick, just watching the markets here, we are seeing the S&P defend that 68.85 level, had that tail dip down to 67.61, or no, I'm sorry, to 60. Let's see, what is that tail dip going? Give me one quick second. I just want to check that out, make sure I got right numbers. Yeah, down to 68.76 it got down to. It has bounced off that, gotten back above that 68.86 level at the moment. So we'll keep that out. Again, recession fears, they've faded sharply, according to this, according to the most recent fund manager survey. Managers are most underweight cash since 2024 and the most overweight equities versus cash since January of 25. If you recall, we were able to hold up gains for a little bit in January before getting that big rollover and shakeout. But, kind of keep that in mind here. Commodities, they're the most overweight since March 2023. In fact, the gold trade was the most crowded trade that we got from from the fund manager survey. That was the first time since June that gold was in there, and obviously, usually that's big cap tech, but gold was once again in there. And again, commodities the most overweight since March 23. Now we have seen a bit of a pullback in commodities the past few days, so we'll see if that works its way in the fund manager survey. If people are deleveraging from that sector, but as far as 2 weeks ago, very overweight. But again, we have seen a small pullback there. Emerging market equities, also the most overweight since February of 2021. The EEM has been performing extremely well. Some of that has to do with the expectations a for the Fed to further ease, which would, of course, be a bonus, especially for countries like Brazil, where they get into dollar-denominated debt, and anything that would help support that. So we'll keep an eye out, see if the Fed pivots in December, how that impacts emerging market equities. But they are extremely overweight, and if we do see the Fed pivot, then that could lead to some money flowing out from there. Keeping with the Bank of America Fund Manager Survey, sector tilts. We had investors increase allocation to utilities, industrial, healthcare, while cutting staples, telecom, and tech, which is interesting. You wouldn't have thought that on tech, but we are seeing that play out again a little bit in the fund manager survey, and on a broader basis. Um, Outside of mid cap tech, we have seen some further weakening going on in that front. So just keeping an eye out on how that plays out. Um, Most investors were saying that they were net overweight banks, telecom, healthcare, and tech. Now, the healthcare one's a little bit of a surprise here, given what we've seen in the terms of the performance there. It doesn't bode well for healthcare breaking out if people are already looking at that being a overweight position. But I thought that was interesting to see that come in as one of the areas where they are overweight. Banks as well too, because banks have been acting poorly as of late. So that's another area where we'll have to continue to track going in towards the end of the year. Now underweight, saying energy, consumer staples, and materials. Um, so there are other areas we'll see if any money flows into it. That halt on the production upticks by OPEC could start factoring in a little bit into those energy plays if we see energy on the rise. However, again, if we start seeing growing concerns about growth and the seasonal weakness in energy also has got to be factored in on that front. All right. So here are a few surveys from the Bank of America Fund Managers Survey. Most crowded trades, again, long gold, long mag 7, and short US dollar. We'll see if the first and third asset class get changed if the Fed starts taking a bit more of a hawkish turn. Biggest tail risks, AI bubble would be at the top of the list. Then you had the second wave of inflation, and then the Fed independence. Fed independence should be an interesting one, given that there's going to be a new Fed chair come next year. So we'll have to see how the market reacts to that. And then source of credit events, private equity. After the First Brands issue, that's really crept in. So a lot of eyeballs looking over at that side. U.S. Treasuries came in second, and then crypto came in third. Pretty interesting that crypto was a distant third on that list. A few years ago, that would have been leading the way, I'm sure. All right, moving our way into sentiment data here. AAII data. Just quick heads up, get an alert from Snowflake, SNOW, as that is moving up through the 280 level. All right. The AAII data. Now, this is one of the areas where we'll be looking at and discussing some of the euphoria that's going on. It's not quite at euphoric levels, but definitely is starting to get to an area where we got to be a little bit more concerned. Bullish sentiment hit 44 last week. Not an extreme by any stretch, but we're going to talk about some of the other areas where one could view it as a bit extreme. 36.9% on the bullish side, 19.1% on neutral. So neutral, that was the lowest level of the year. So people are definitely taking sides on this. Here's the AAII bull ratio. You can see it's kind of sitting right in the middle of the range. So it hasn't really hit extremes just yet. But this had been pulling back down. Saw a little bit of a pop higher here. If we start getting above that red level, well, that's where you're going to have to start getting a little bit more concerned about things. But the issue with AAII bull ratio is that the bears are keeping it in check. So you do have that skepticism out in the market that's not letting that euphoria get away from itself, which obviously is supportive of it can move higher here. Real quick, headline coming out across now. Treasuries expected to borrow 569 billion in Q4. Just the prior for Q1, they expect to borrow 578 billion. So that borrowing estimate, that's 20 for a Q3 of 569 billion. That is 21 billion lower than announced in July 2025, primarily due to the higher beginning of quarter cash balance, partially offset by lower projected net cash flows. Excluding the higher than assumed beginning of quarter cash balance, the quarter borrowing estimate is 20 billion higher than announced in July. So just keep an eye out on that. That should be positive news overall, I think, for the broader markets. Now, next up will be the Treasury quarterly refunding. That will be released at 8:30 a.m. on Wednesday. And of course, that's expected to see a big uptick in shorter term issuances. We heard Powell talk a lot about getting more in line with the Treasury Department, and the expectations are for the Treasury Department to issue more short-term T-bills. So we'll be watching that come Wednesday. But that information that we just got there from the Fed should be a positive for the broader market here, certainly for bonds. All right. Um, so again, let's go through this AAII summary. So surge to 44%. That was the highest since early 2025. The 8-week moving average of bullish responses, that now exceeds 39%. That's a level that's historically been linked with early signs of over-optimism rather than skepticism. So again, sentiment data certainly starting to work its way into the bull side. Sentiment was pretty muted for the first half of 2025, of course, with the tariff worries and Fed uncertainty, but then it stabilized in late summer. Now we're starting to see it tick up into more of a, of a enthusiastic uh, enthusiastic response. The pace of rise in optimism that has outstripped improvements in market breadth, indicating investors are pricing in further gains without equivalent data confirmation. So, again, that sentiment suggests that people are expecting some further upside here, even without that breadth expanding. Um, so again, we've seen investor psychology swing towards confidence, yet sentiment metrics suggest that the market may be approaching conditions that often precede short-term consolidation. So we've got that potential for a short-term pullback, but again, we're not at a euphoric level suggesting a big correction is taking place. We're simply in the midst of a little bit more of a consolidation phase with a lot of liquidity, a lot of optimism behind us. So it's going to really take something to knock us off that pedestal for a bigger, stronger correction. Uh, let's take a look here at the NAAIM exposure next, and this will be pretty interesting. So you can see that bar going up towards that 100 level. That was the high. That was the reading from October 29th, and that marked the highest reading for 2025 there. So that suggests full risk on positioning. So what 100 reading on the NAAIM suggests is that active managers are now more than fully invested. Remember, we had that number before about the 100% plus exposure going on by active managers. The 100 reading marks the highest exposure level since May and signaling strong conviction in that ongoing rally. Readings above 100 are relatively rare in the NAAIM, and they have historically coincided with late stage momentum phases rather than early accumulation cycles. Now, the deviation of 55.36 in that NAIM survey, this is modestly below the early October highs. That reflects positioning tightly clustered near the upper bound. Again, this kind of shows managers are collectively leaning long rather than expressing a wide range of views. In practice, that means conviction is high, but differentiation is low, which is, again, a classic sign of herding behavior going on from what we could read through the NAIM exposure. This index has risen 3 consecutive weeks, mirroring the surge in the AAII readings. So again, sentiment is starting to get a little over exuberant, has not hit euphoric stages yet, but something that bears watching. And it could perhaps limit the upside too when we're talking about the positioning and the sentiment. But, in order for that positioning to loosen itself up, we need a small little shakeout, see some profit taking, and then see what other money we could get, see if that cash could come off the sidelines to help support things. But again, this points to that liquidity that we were talking about in the M2 money supply. There's just a lot of liquidity out there. SPY liquidity premium. This is look at that dip going on right there. So what we do with the SPY liquidity premium, if you recall, is when investors get a little bit more nervous, they tend to sell stocks and start trading more of the larger indices, either going short or going long those sectors. And you can see we hit that green button, which means a little bit euphoric, right? That means that not a lot of people were in this trading the SPY. That's had a big spike the last couple of days here, suggests that there is some pullback in expectations going forward, a little bit of top heavy action, and people are getting a bit concerned. So we are seeing that in the SPY liquidity premium. Here's the cash levels, working our way through that. You can see you got that page, or you got the live slides. So they should be in under one of the at the top there. You should be able to find it. Here's the cash levels, just kind of showing that big drop off down below the red level. That tends to show signs of euphoria. So Bank of America isn't seeing a lot of cash on the sidelines there to take it up. But again, that liquidity premium, it does make you wonder how much cash is out there, and if this reading could be a little bit off because of that. So this would point to a more of an opening of a bit of a steeper correction. But again, the liquidity is the one issue that has me questioning that. Here's again cash levels record net 60% of I'm sorry. This is fund investors' view of the valuation for the markets. And net 60%, this is a record, see global stocks is overvalued. The global stock index hit a record high, and you can see that there. So here's the thing, we haven't really sold off. People are concerned about this valuation, and this to me sets up more for a FOMO rally than any sort of major correction, because nobody's really selling despite so many people viewing stocks as overvalued. They want to go along for the ride, and this supports that notion there. Okay, here's the liquidity conditions from the fund managers survey, highest since September of 21. So there's really been no issue getting cash. There's been no issue with margin at all or anything along those lines, which could help offset some of the positioning and in cash and equities that we've been seeing. So again, lines up for a little bit of a pullback, but overall the upward trend has plenty of support when both on the liquidity side and the technical situations. So these liquidity conditions, This would also help point to the idea that the Fed doesn't really need to move in December either, as this has not been an issue for the broader markets. Here, looking at the sentiment trader, here's the equity hedging index. You can see we were starting to get a little bit of an uptick in equity hedging, but this has reversed lower over the last couple of days here. So not a lot of hedging going on at the moment. This is something that we'll have to continue to track, and watch and track moving forward. But bit of a pullback going in on that side. Certainly not at any sort of euphoric expectations on the equity hedging side. So it leaves an opening for more hedges to be put on. If we start seeing that, that could lead to an uptick in the VIX and perhaps a bit of a pullback going forward here. So the equity hedging index will continue to monitor this. The robo put call ratio, of course, this is an area that we're always watching just to see the options trading. Now, obviously, you can see this has gone over a couple of times over the last few years. Last time would have been in December of 24, which preceded that pullback in January. You can see that big drop off going on into April there. So we're going to see if this follows a similar pattern. But again, we did get a push higher through most of the end of last year, and then saw that selling kind of rattle things at the beginning of January. They did try to make a press higher, and then the tariff headlines and the DeepSeek headlines really rattled the markets there. This time, very similar pattern going in towards the end of the year. We haven't quite hit that euphoric stage since that drop off there, but we were getting down to levels that would have begged for a correction, yet we did not get that correction, which to me, again, points to the idea of a market that people really don't want to leave just yet, despite some of the euphoria that we're seeing in different areas. All right, so bottom line is when we're taking a look at the options activity, the sentiment activity, and the liquidity, how I see the market going forward is there's definitely froth at the top right now that could get blown off, uh, be it a headline, be it just selling in the mega cap names, a little bit of a technical breakdown. We talked about that 20 and 50-day moving average, which leaves ourselves susceptible for a bit of a pullback here. We certainly talked about sentiment being high, not euphoric, but high, and then positioning also being high, again, not at euphoric levels. So for me, I'm still waiting for a little bit of a shakeout, small correction, the 2 to 3% garden variety. But when we take into consideration the liquidity, um, the idea that we haven't quite hit euphoric levels in sentiment and positioning, there still remains upward momentum in these markets, and there's nothing in the data that I'm seeing that suggests otherwise. You could argue that we're simply too high on the sentiment and the positioning's not there, that it's going to open itself up for a broader pullback. But I think that you got to keep in mind those liquidity conditions, be it the money supply numbers that are out there, the simple amount of cash that's on hand. I don't think that that's been appreciated enough on this move. And when we start seeing some of the different areas out there, it suggests that while historically some of the sentiment and positioning data suggests that we could see some selling off, I think it sets up a little bit more for a small shakeout, but the upward trend to continue going into the end of the year. All right. So going to tease this a little bit, and we're going to talk next time. I'm going to put together more information on this, but investment bubbles, because that's obviously going to be the big question going into 2026 around all this activity here. We're going to do a recap of some of the more recent one or some recent ones. Basically some of the characteristics. Every major investment bubble started with real innovation, be it railroads, electricity, the internet, or AI. The issue is when capital prices, the 10-year build out as if it's a 10-month rollout. We're certainly seeing that put into place right now. Um, Investors, they consistently overfund execution risk, assuming every project will be built on time, at scale, and at perfect utilization from canals to data centers. Again, this is one of the things that we have seen play out the last couple of days. Herding behavior drives valuations. When everyone believes they'll be the monopoly winner, duplication and overcapacity follow. We talked earlier about that herding behavior that is going on right now. So that is certainly one of the investment bubble tenets. The washout phase, that comes not because the technology is fake, but because too many players chase the same inevitable future on impossible timelines. Starting to see that certainly a lot more playing out on AI, with everybody trying to jump in on AI, on the AI front, and get involved in some sort of different way. So, and then today's AI buildouts rhymes primarily with the dot-com, telecom, and the Japan Inc. eras, right? So there we saw real innovation, political backing, of course, and massive capex, priced as if flawless execution and instant monetization are guaranteed. Remember, next year is going to be an election year for the midterms. If we start getting a sense that the Dems are going to take a substantial amount of seats, then some of those nuclear initiatives could be put into place. So kind of keep that in the back of your mind there when we're talking investment bubbles. So again, some of the ones that we'll talk about, the railway mania of the 1840s, the canal mania, late 1700s, early 1800s there. Electrification and industrial trusts, that was right around the industrial boom, of course, where we saw a lot of overbuilt power and lighting roll-ups promising monopoly dominance, but most failed or were consolidated. You got the Florida land boom of the 1920s, where folks are speculating on undeveloped land that's sold as luxury properties. Also had a lot of hurricanes going through in the 20s when people weren't really necessarily prepared for that. So uh, real interesting read if anybody ever gets a chance, called The Furious Sky. It's all about the history of hurricanes. It talks a lot about that Florida land boom and how those changed the history there. But, um, that's another investment bubble there. The conglomerate booms of the 1960s also fall into this. The Japan Inc. bubble in 1980s, that's what we'll be uh, keeping a lot of our time on, where we saw corporate and real estate euphoria assuming endless industrial dominance. This was crushed by overcapacity and demographics. And the dot-com bubble, which I think most people view this as a second coming of that. We're going to take a quicker look at that unwind there. The SPAC boom of 2020 through 2021. Not as much there. That was kind of more of a trading bubble than an investment bubble, I'd say. But just if we're looking for similar activities. And then you got the urban redevelopment mini bubbles, the 80s and 90s. So we'll be looking at all those. And then the other thing that we will be taking a look at, it's called The Furious Sky. Again, all about the history of hurricanes. Super interesting read there. I read it figuring I better figure out what goes on with hurricanes if I'm going to be living in North Carolina. So fascinating read, just talking about how Morse code expanded the weather stations and all that stuff. Yeah, Furious Sky, exactly, Pedro. I got to double check the name of the author, but I do believe that it was Jay Dolan. So, um, okay, then. So I'll put together a special one just on AI bubbles. We'll talk all about the deals that are being done. We'll look at valuations of everything. Again, we're running on about 50 minutes here in this sentiment and flow show, so it's just going to be too big of a beast. And the other thing that I will talk about too is seasonality. That'll be a third show that we will do here. But I did include the median 2-week return of the S&P since S&P 500 returns since 1950. Top one has been the second half of July. Then you got March. Then you get the first half of October. We definitely had a good period there. Then you got the second half of December, which bleeds into the first half of January. And you got the second half of November. and the first half of November. So for the next 2.5 months, the only one that is not in there, as you can see, would have been the first half of December, which is down lower. Still positive returns there, but certainly didn't get it. Now, of course, the worst returns come in the second half of September. We did not see that seasonality, so that begs the question: is there a pull forward? And it's a good question, but again, we've talked a lot about the strength of seasonality providing support, and I do see that coming. So just to go back and recap some of the more interesting elements that I talked about here today. Number one, that stat about the S&P being up 15% going into the final 2 months. 20 out of 21 times we have ended higher. Second, look at the seasonality that we got going on there. First half and second half of November tends to be extremely strong. A little bit of a lull in the first half of December, but the second half of December tends to be strong, and that usually bleeds into the first half of January. So we got seasonality in play. Um, Liquidity. We talked about the M2 money supply. We talked about the liquidity conditions in the Bank of America Fund Manager Survey. There's nothing out there that doesn't suggest that we can't get some further leverage and that we can't get more and more people uh, coming in to this market sitting on cash, because the cash weightings that we're looking at could be a little offset this time around due to the amount of M2 money supply in the markets. We've got the Fed with a little bit of a stealth easing by ending that Q2 roll off. Um, so that could also come into play. Also, potential for a December rate cut as well. So all that's factoring in for the tailwind. Now, sentiment, that has gotten a little bit more euphoric, but as we've seen, it's not at the levels that would have us raising a red flag. There's still a lot of bears out there. We ran through the bears of the AAII, and there was plenty to suggest that. We also talked about the equity hedging and the SPY liquidity. So there are suggestions there that there is enough to that euphoria has not gotten out of control. Now, we did talk about some of the breakdowns of the short-term charts, which again leads itself to a bit of a pullback here. But given the liquidity and given the positioning that we're seeing, I think that it just lines up for a push higher. And then finally, on the positioning side, we're certainly starting to get a little bit more on the full boat. But as we saw from that bear survey in the AAII, there is still a little bit of room on the sidelines for some FOMO rally. So the longer that we stay elevated here, the longer that FOMO kicks in. So I'm looking at either a small correction, call it 3% correction, which now I'm going to flip over to the chart in the S&P. We'll take a look at the futures. And what I would look at running into 3% correction, it takes us right down around that 50-day moving average. We talked about the run above the 50-day moving average on the closing prices for the S&P. So, that certainly could be an area where we see things get tested. But I think that would open up a great buying opportunity, and you'd see a lot of people come into play. The other likely scenario I see playing out is just kind of a bounce around in this 60, call it 6750 to 6950, and we just kind of chop around in that area for the next week and a half or so. And then if we started bubbling higher, I think that some of the money on the sidelines would start pulling out, as well as we'd see that liquidity in all its might, and we'd see that FOMO trade coming out too. So that is how I kind of see things playing out here. I hope this was helpful. I know not having Brett is obviously takes away some of the charm from this, but the numbers that were discussed are all still in play. Hopefully that presents you with a good opportunity. I will be posting the replay of this as well as I'll look to see about getting that PowerPoint presentation on it. We'll just kind of continue to build off this, but hopefully this gives you enough of a backdrop that you can kind of feel confident with your decision making. We will expand this into those two other shows that we talked about for the AI bubble and for the seasonality, talk about some of the things there. And if there's any polls that you'd like to see me run off of this, feel free to let me know. So with that, just going to run under a little bit under an hour. I'm going to shut this off. I'll jump back on here in a couple minutes and we'll get ready for the close.